We're going to look at the stock Yelp. And Yelp is a website people use to review businesses they've been to. And also Yelp generates revenue from charging businesses to advertise on their website. So what I do in my videos is I try to figure out the value of a stock using the company's prior financial information and also looking at the capital structure. And then I look at the financial ratios of the business and compare them to their competitors. So let's get started with the model. The company's market cap is $1.6 billion. So that's the value according to the stock market. And let's see what they're trading at. They're trading at $22.74. So one share of stock is roughly $23. To value a company, we have to estimate the future free cash flows and then discount that number back to today's value, which is what I'm doing in the video. What I just put into the model was the actual free cash flows from the business. Now I'm going to go to the income statement and get their net income, which is a profit and loss. And then I'm going to get the revenue, which are the sales. So the best way to value a company is to look at how they've been performing in the past. Just like if somebody wanted to sell you a business, you'd want to know how much money the business is generating and the profit. In 2016, they had negative net income, yet positive free cash flow. That can happen because there can be non-cash items passed through as expenses on the income statement. And their revenue seems to be growing each year, which is good, although their margins are decreasing a lot. In 2019, they had $1 billion of revenue, yet posted only $41 million of profit. So their margins went down pretty dramatically. Margins are income over revenue. So they're doing a poor job converting the revenue into profit. Let's look at the capital structure of the business so we know what discount rate to apply to the future cash flows. They don't have any debt, so let's get the cost of equity. We need the beta. And the beta is how much the stock moves relative to the entire market. And they have a beta of 1.47. So the stock moves about 1.5 times the market. Next, we need the current assets. And the reason we need current assets is because we're going to look at the current ratio later. And the formula for current ratio is current assets over current liabilities. And current assets are mainly cash, accounts receivables, and inventory. It's what a company uses to run its day-to-day business. Next, we're going to pull current liabilities. And these are debts and payables that are due within 12 months. And that's $134 million. Next, we're going to pull the equity. And that's assets minus liabilities. That's $755 million. And we need this number to calculate the price of a book value formula and the ROE. Now we're going to pull the EBIT, earnings before interest and taxes. And it's called operating income on the income statement. And that's $35 million. And we need this number to calculate the interest coverage ratio. Let's look at the capital structure. So the cost of equity is 13.61%. And we use the capital asset pricing model to figure that out. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $1.3 billion. We divide that by 70 million shares. And we get an intrinsic stock price of $18. It's trading at $23, so it's trading at a 26% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. Their number is almost $21, so they're a little higher than mine, but in both cases, we're saying the stock is overvalued and it's not worth what it's trading at. Let's see what the stock has been trading at. It looks like it was trading in the mid-40s maybe a couple years ago, but it's dropped quite a bit. It's at a pretty low point. So maybe the market just doesn't see the future of this company being too strong, so they're not willing to pay $40 or $50 for the stock. Let's look at the financial ratios to get more information. They don't have a good PE ratio. That's price of stock over earnings per share. I like to see under 15. They're at 39.1. They have a good price to sales ratio of 1.6. That's price of stock over sales per share. Remember earlier we were saying they only had $41 million of net income from $1 billion of revenue. Only a 4% net profit margin. They weren't doing a good job converting their revenue to profit. That shows up in these ratios. Price to earnings is price of stock over earnings, which is net income. And that's why it's so poor, 39.1. And the price to sales ratio is price of stock over revenue. That's why price to sales looks so good, because they're doing a great job at generating revenue, but not a good job at turning that revenue into profit, which is the price to earnings. Price to book is pretty good, 2.1. That's price of stock over book value per share. And book value is the equity, which is assets minus liabilities. They have a good current ratio of 4.0. That's current assets over current liabilities. It might actually be too high of a ratio. They don't need that much current assets, but at least it's above 1. They don't have a good ROE, 5%. That's income over equity. I like to see 20%. And that's because they just have such poor income for the amount of equity on their balance sheet. And that's the formula of ROE, income over equity. The best way to look at ratios is to compare them to similar companies. And I've done videos on Facebook, Google, and Match. And here's Yelp. And if Yelp's numbers in red, they're worse than the average. If they're in green, they're better than the average. So PE, of course, they're worse than the average because they don't do a good job at generating earnings. They have the best price to sales and the best price to book. All the companies have a good current ratio above 1. They're worst in ROE at 5% because they're not generating that much net income. Yelp and Facebook have no debt, and Google has almost no debt. In terms of market cap, Yelp is the smallest company. So let me know what you think of the video. Thanks for watching.